Hello and welcome to the update on Amati Global Innovation Fund. We do this roughly every 6 months to bring you up to speed to what's been happening in the portfolio, but also remind our existing and new clients some of the key features of our investment process. We have a presentation that we're going to go through, and I'm just going to share this the slides with you. If you bear with me just one moment. And Graeme, you will keep me right. You should see a window on your screen with our title slide.
Yes, great.
That's great. A quick reminder that nothing we say is a recommendation to buy a stock or a fund, and we encourage you to do your own research and seek professional advice. Of course, this disclaimer is also available on our website. With that, a quick reminder of how we invest. As you know, we are a high conviction global equity strategy. We invest in pioneers, enablers, and adopters of innovation. Graeme will remind us why this taxonomy is important and how we define these categories. But common to all of this is the opportunity we pursue. We believe innovation creates a lot of value. It accelerates growth. It deepens the moat of an innovative business, making it more profitable in the long run. But it is associated with complexity, with uncertainty. It impacts across the value chain, and therefore is sometimes mispriced by the market. So that is the opportunity for us as active stock pickers. A lot of value creation, but mispriced by the consensus. We approach this opportunity with a set of disciplines. One is we embrace complexity. Innovation investing takes us to exciting but sometimes technically complex areas, and we're very comfortable with that. We like that because that's where the opportunity often is. But we combine that embracing of complexity with focus on valuation, profitability, and cash generation. As we sometimes call it, we buy good businesses, not science projects. And then we work hard to develop an edge and grow our edge in capturing this opportunity for our clients. We obviously been doing this for many years, delivered good results for our clients, both here at Amati and our previous firms. But we also do things a bit differently. We read more widely. We go to a lot of industry shows, industry trade shows, where we see companies in their natural habitat. We're sometimes one of the few investors in the room or in a large exhibition hall in these places. And collectively, we do deeper work on the sort of innovation frontiers that we pursue, and that gives us, we believe, informational advantage, and results in a portfolio that is quite different and we think complementary compared to many of our peers.
Yeah, and just a reminder, it's not a technology fund, it is an innovation fund. So we will follow the innovation to whichever companies are best positioned to benefit and have the lowest risk. So this takes us to a lot of industrial, a lot of healthcare companies, but we can go into any sector. We are looking at quite granular innovation areas, so that tends to take us into what you consider sort of US mid-cap. Our sweet spot is between about 2 and 25 billion typically, and you can see the average for the fund here is significantly lower than the benchmark. We care about value. This is not a value fund, but we care about what we pay for the stocks. So we want these companies to survive through long term. We're 3 to 5 year investors. So we're looking for companies that have strong balance sheets and strong free cash flow generation, but we don't want to overpay. And we'll see that more as we go through the presentation. But you can see here strong earnings growth for not too dissimilar multiples to the average for the benchmark. We're focused, so up to 40 holdings and very different from the benchmark. We're 99% active share typically since launch. Mikhail mentioned that we do look at pioneers, enablers, and adopters of innovation. And I won't go into too much detail now. We'd be very happy to talk you through more detail. But essentially what we're trying to do here is to suggest that the value doesn't always accrete to the early stage sort of innovators and sort of the companies that design or build the innovation in the first place. Sometimes it accretes to the companies that support them. We call those enablers. So these might be providing goods or services to the pioneers or into the infrastructure, into the general infrastructure of whatever that innovation area is. And likewise, it can accrue to the companies that adopt the innovation into an existing customer base or product range. And again, we call those adopters here. So the point is to say that we go to wherever across the landscape the risk reward is most attractive, and it's not always the companies that are designing the innovation in the first place.
Going to the fund as it is today, this is a bird's eye view of our portfolio. You've seen this chart before. The thing we care about a lot is what we call innovation frontiers. So this kind of granular outer circle, which you see here on the chart. These are the areas of innovation and technological change, which, as we sometimes call it, pass our innovation test. This is, the future that's already here, just not even distributed. It's something that's happening. It's making a difference. It's adopted by the industry. We're not imagining how the world might be or how the industry might work in future. We're seeing this today, and we're riding this adoption curve. And some of those are familiar areas to you, and obviously AI is a big theme, and we certainly have exposure to that. But some are pretty specialist. Things like multiomics, which we think will drive the next generation of drug discovery and biological breakthroughs. Areas of defense technology where the world continues to be uncertain and dangerous, and the emerging threats on the battlefield or in the geopolitical sphere demand different and innovative solutions to keep the Western world safe. And this gives you a little bit of a summary of what is typically somewhere between 15 to 20 innovation frontiers that we're exposed to, the companies that we've picked, which are the best risk rewards, the best exposed businesses to benefit from that innovation and technological change. But we're also aware of this big systemic shifts, moves to more digitalization, more automation, aging population demanding healthcare innovation, and of course the geopolitical change that are the tailwinds. They're not something we've discovered. Our work begins on much more granular bottom-up level, but those are the tailwinds that our companies and our innovation frontiers benefit from. And we're going to spend a little bit of time on three of those areas where we've seen really moved the needle for the fund in the past 6 months. So we've been adding to the portfolio or adding new stocks to that innovation frontier. We'll unpack this in a bit more detail over the next couple of pages. And starting with the one that's been in the portfolio since the start, but really paid off over the past year. And we're very comfortable with the time it takes. We can be very patient. We effectively waited for almost 4 years for our photonics bet to come good, and it did deliver in spades. And for those of you who follow the fund for a while, we held photonics ideas in the portfolio right from the beginning, from summer of 2022. And the thesis behind the photonics innovation frontier is this: as the volume of data that you transfer from point A to point B grows, and your bandwidth requirements, your requirements for latency or low latency increase, at some point electronics just doesn't do the trick anymore. The moving electrons in copper wire is inefficient and then becomes physically infeasible. And so you have to move to moving photons, to moving light in fiber. You have to move to photonics and optical communication. Now, we are very familiar with that as consumers. Our domestic broadband made their journey over the past many years, from dial-up to fiber to the telephone exchange in our area, to fiber to the cabinet, to fiber to the curb, to now fiber to the home, which is increasingly the most popular broadband product in the Western world. The same fiberization of networks, of switch to photonics, happened in the enterprise and data centers, or is happening, we should say, where more and more places, initially data center to data center, then rack to rack, server to server, and now the industry is working at something called scale up, which is basically almost chip to chip communication using optical means. That fiberization is evolving rapidly, and it's been really accelerated with the needs of AI data centers, which of course are the most demanding, high-performing data centers there are. And the beauty of that is the industry that serves this demand, the photonics industry, is very disciplined, consolidated, what we sometimes call cottage industry going mainstream. These are companies that honed their craft over decades, serving the needs of telecommunication companies that suddenly found this huge expansion of opportunity when AI needed what they've developed. We owned Lumentum, which is the leader in active optical components. Think lasers that light up the systems, but also passive optical components. Think bits and pieces that manage the light as it transitions from point A to point B, switch between lanes, that sort of thing. So Lumentum is the global leader, one of the best pedigrees in the space. And we also bought a few years ago a company called Fabrinet, which is a leader in contract manufacturing. These things are very sophisticated devices. They're very hard to make. This isn't your kind of run-of-the-mill smartphone or computer server, and Fabrinet emerged as a dominant leader in making these things. And we've seen multiple returns on our capital over this period of time, and this continues to be a significant exposure for us. But we feel maybe the best returns are made, and we're kind of considering our options. We're reviewing the positions as we speak.
Yes, but that's kind of the opposite to the situation on this slide. So obviously everyone's aware of the massive impact that AI, and particularly generative AI, is having on the tech industry. But it's starting to radiate out into the real world, and this is known as physical AI, so the kind of physical manifestation of that technology. And it's happening in lots of places. You will see it, everywhere in your life increasingly. You'll see it in different parts of supermarkets, in cars, and obviously it's happening a lot in industry, and particularly across manufacturing and logistics and automation. So it's an area that we see a lot of interesting growth opportunities, but it accrues to a couple of very specific niches, we think, and those are areas that we're particularly interested in. One of those is machine vision. So as the AI brings more intelligence to robotics and to production lines, these machines need more sensors. They need to be able to see where they are, what they're doing, and to be able to identify products and monitor quality much more accurately. And so machine vision is exploding literally in terms of demand across these different areas. And it's quite a niche business in terms of the number of players. So we have a couple of investments here. One is Cognex, which is a company you can see top right, that embeds a lot of AI into their products to kind of democratize them to companies or to businesses that couldn't afford this type of technology in the past. But now, because of AI, they're very easy to set up, and they can either enhance the workforce or replace, in some cases, parts of the workforce. So the return on investment is very strong and very significant. Likewise, Basler, which makes a lot of the camera components and is a big sort of white label manufacturer for a lot of other companies into this sector. So they're really well positioned to benefit as we see an explosion in demand for this type of robots. The other area that we're really interested in is particularly in life sciences. So AI is driving a huge increase in the number of available molecules or chemical compounds that can be used to go into research to find new drugs. So AI is identifying compounds that can serve particular disease pathways much more quickly than humans are able to do. And in order to test those, we still need to use the lab. So we can do a certain amount of testing using just AI models, but ultimately, before things go into the body, they have to go into the lab to be tested. And this is where AI, in terms of automation, is really speeding up that process. And there are a couple of companies that are very well exposed. And one of them is Tecan, which we're invested in, which is really a pure play in this kind of life sciences automation. And then lastly, the other area that's really important, obviously everyone knows we're seeing a lot more robotics almost everywhere, not just sort of robot arms, but increasingly kind of hybrid humanoid type robots, robot dogs, all sorts of different robotic applications. These all need a huge number of sensors to know the speed of movement of the arms or whatever the limbs of the robot and exactly where they're located, so speed and location. And those sensors are provided by companies like Allegro, and Allegro is a leader in this space. So again, we think incredibly well positioned to benefit as AI sort of percolates into the physical economy.
Last one we're going to talk about is bioprocessing. This innovation frontier has been in our portfolio for a while, but we've been adding to it lately, and we're seeing, we think a really nice inflection point that started to manifest in the last set of results this company has delivered, and will become more visible to the market during the course of this year. Just as a reminder, what bioprocessing is, the way we manufacture medicines is changing. Historically, most of them were chemically synthesized. They were so-called small molecules, but increasingly they're biologically produced. We're seeing acceleration of new drug launches anyway, so the pace of innovation that Graeme's alluded to is increasing. But within that, the share of biologics is increasing as a percentage. So, the most of sales of medicines on the market today are still, if you like, legacy small molecule type drugs. But if you look, I think last year was the first year when biologics exceeded or reached 50% of the new drug approvals. So there's a switchover going on. And if you look at the pipelines of drug development, you see a lot of biologics or even new modalities, cell and gene therapies that kind of hijack a body mechanism to cure the disease rather than just use a biological process to manufacture the active ingredient. And so the way the bioprocessing drugs are manufactured, medicines are manufactured, it involves effectively a genetically modified cell line, a community of cells living in a bioreactor, and they've been engineered to produce or secrete an active ingredient that does something useful in the body, rather than whatever the hormone the cells originally evolved to produce. In fact, some of you may have heard this already from us, but the vast majority of the cells are so-called CHO cells, which stands for Chinese hamster ovaries. So there's one particular consequential hamster who, donated her cells sometime in the 1960s, 1970s. They've become immortalized, engineered to perfection, and now saving millions of lives by producing this life-saving medicines. The interesting thing for us is if you look at the manufacturing process behind this, the difference between chemically synthesized small molecules and biologically produced biologics is a bit like the difference between an oil refinery and a yogurt plant. It's a completely different process. It's very multi-stage. You see the process flow at the top of this chart with lots of very distinct stages. Very high barriers to entry. We're talking about a drug that may have taken billions to develop, and now we need to manufacture it. And a small mistake will result in, at best, a lost batch. At worst, is disqualification of the whole manufacturing facility. So, pharma companies are incredibly risk averse, and when it comes to picking suppliers, only the best would do. And chances are, if they picked somebody at the clinical stage and the development stage, they'll stick with that supplier for decades thereafter. And this industry is another one of those, we want to say, cottage industries going mainstream. These are fairly large companies, so they're large cottages, but nonetheless they're very consolidated. They're really kind of 4 to 5 companies that matter, and usually we own 3 of them because they all do different things better than others. So depending on where you are in this process flow, Sartorius, Repligen, and Danaher excel at certain parts more than others, and these are great business models. They are very sticky. As I said, nobody switches supplier midway. So once they're picked, they stick with the pharma customer for a long time. Typically, 75 to 80% of their revenues are recurring, so they're consumables or reagents. So it's a very predictable business, and the whole business is growing with the growth of biologics complex. And they're making kind of 20% plus operating margins. They're growing their revenues high single digits and potential to grow more, and have nice operating leverage below the line. So really, great business models, in our opinion, very competitively priced. So we've been adding to this as a result of some of the kind of really promising positive developments over the last sort of 6 to 12 months.
And as I mentioned earlier, we care about valuation when it comes to the companies we're buying. So there's some stats here on the fund overall. You can see, again, we're not paying a much higher multiple than the average for the market, but yet getting considerably higher earnings growth. And these numbers are consensus numbers, by the way, not our numbers. But within that, you're still getting businesses that have strong free cash flow yields, broadly in line with the average for the benchmark, but equally strong or even stronger balance sheets. So you can see net debt to EBITDA, they're even lower than the average for the benchmark. And note the difference in market cap. So we're significantly lower on average than the benchmark, which is the all countries world. So very much not a mega cap bias, much more focused on where these innovations are really dominating in the kind of mid cap space.
Viewers and performance, we had a good year. If you look at the 1 year number, we are meaningfully ahead of peer group. We're ahead of the benchmark, and delivered very strong absolute return. This is to the end of April. But actually, our 2 years and 3 years are also meaningfully ahead of the peer group. We're proud of that because we've spent the 3 years without having anything in the Magnificent Seven, pretty much. And as you know, most global returns have been driven by the Magnificent Seven stocks. So we demonstrated that we can deliver returns without going into the same popular, crowded stocks that many other of our peers are holding. And of course, with the 99% active share, we have very little overlap with the global index and global index funds. So we've delivered, in our opinion, very complementary returns. You see that on the table on the right hand side. These are the top 10 return contributors over the last 3 years, and you can see that they are often companies that are not front of mind. They're not in other people's top 10 lists. Companies like Lumentum, like MKS, like Rank Group, like Prismian. They've done wonderful things for our clients over the period of time. And we know our clients made a lot of money on the Microsoft and Alphabet and NVIDIA elsewhere. We're very happy for them, but we felt that we've added something extra to their portfolio that they otherwise wouldn't have had. And we care about that because, as many of you know, we seeded the fund with our own capital, and most of our family's financial savings are in this fund. So our interests are very much aligned with that of our clients.
And as Mikhail mentioned earlier, we go to a lot of industry trade shows. So this is an important differentiator, we think. We use these as a ways of sort of testing our views on innovations, but also learning about new competition and new developments in industries by talking to the engineers and the salespeople that work in those areas. And this is just some pictures of the ones we go to. They tend to be kind of big drafty halls in places like Hanover and Wiesbaden or Glasgow or even the NEC quite a lot. So it's not always super fun, but we enjoy doing it because we learn a great deal.
Yeah, if you want any detail on the robotic bricklayers or a particular optical transponder, talk to us. We'll be very happy to share more detailed feedback from all these events. Great. Well, that brings us to the end of our update. Just to summarize, we think the opportunity is persistent and evergreen in innovation. There's a constantly dynamically evolving world out there. Innovation creates a lot of value in the companies that we follow, but it's often mispriced by the market. Even though some areas of innovation are well publicized and front of mind, many others are still terms and acronyms that are new to many investors. And we're very excited about what we have in the portfolio and what lies ahead of those businesses if they deliver. We continue to embrace the complexity that comes with innovation. We're very happy to dig into those technical areas, go to those trade shows, speak to experts, read more widely to understand where the opportunity lies. But we combine that with focus on great businesses, not science projects. So valuation discipline, focus on profitability and cash generation. And we continue to deepen our edge. We dig deeper than many of our global generalist peers do, and we certainly dig deeper than we had done in our past when we ran less specialist, more all things to all people global funds. So we feel like it's very a subjective judgment. Do you know more than the market about the average subject? And this is our test. This is our non-consensus test. Do we feel that our opinion on the journey of this innovation frontier and this company within that innovation frontier feels different from what the market fully understands and prices in today? And unless the answer is yes, we wouldn't be wasting your capital backing that stock. So we certainly have a lot of such ideas in our portfolio, and the result of that is a portfolio that's quite different. obviously pretty much completely different from the global index, but also very different from our peers. So our overlap with our peers in terms of what we hold and where we made money continues to be very low, and we think that adds something for our clients that they don't get elsewhere in their holdings. So we're enthusiastic about the future. We're pleased with the growth in our assets. We've more than doubled our fund AUM over the past 12 months, and look forward to continue to deliver for our clients. And thank you very much for your interest.
Thank you.